Good day, grade 12s. Welcome to exam prep investment securities. Right, as promised, I said I'm doing videos on business ventures just to prepare you for paper 2. I've already done a video on management and leadership, and after this one, I'm going to do insurance. Yes, and let's get you guys passing paper 2. Right, so this one is securities, and as usual, I'm using past papers from the Department of Basic Education. And my name is Carden Madzokere. I'm the author of the Distinction Bound Student Textbooks. I have economics grade 10, 11, and 12. And there's also grade 11 and 12 for business studies. Right, so let's get started. Right, identify the type of shares represented by each statement. Okay, number 1, shares are issued to existing shareholders as compensation for loss of dividends. All right, when this happens, what kind of shares are these? Maybe just to give you a background a bit, we have ordinary shares and we have preference shares. Now, preference shares, they come in so many, in so many forms. Like we have non-cumulative preference shares, we have cumulative, we have participating and non-participating, we have redeemable and non-redeemable, we have convertible and non-convertible. You see, that's 8 if I'm not mistaken. Okay, so we have that. We also have bonus shares, and obviously these ones are given to shareholders as compensation for loss. Okay, I think I'm already telling you. Right, then we have founders shares, and that's what I'm thinking about right now. And the founders shares are those that are given to the initial shareholders, the ones that sort of subscribed to the memorandum of incorporation when you initially registered the company, the ones who started the whole idea. All right, so which one would this be? And I've said it when I was telling you what bonus shares are. That would be bonus shares. Okay, the next one. Okay, so these are two free marks. Shareholders receive their dividends before others can be paid out. Okay, these ones are those that are preferred. So this one will be preference shareholders. And in most cases, look, mostly when you go on the JSE and buy shares, in most cases, not in all cases though, I've never bought preference shares, never in my life. I'm always buying ordinary shares. And it's not like there's no provision for that. I see, I don't know, for some weird reason, I never ever buy preference shares. And I don't know why I've never, and I'm sure majority, maybe it's because there's less volatility there. And in some cases, people love that sort of risk attached to ordinary shares. I think that's the reason. Right, these shares are issued to shareholders who started the company. We said this already. These will be founders' shares. These shareholders may receive higher dividends when the company has made. I talked about these also, the ordinary shares. Like I said, I love them because there is risk. There is too much volatility. But then the downside is if the company was to go bankrupt, ordinary shareholders, they are last in line. They will have to make sure that preference shareholders get it first. You can even see they receive their dividends before others can be paid out. These guys, even the name itself, they are preferred. So preference shares or preference shareholders. Alright, the next one, outline the functions of the JSE. Okay, look, this question on this, when I was preparing this video, this question actually, it appeared probably 5 times from 2017 to 2019. So I didn't repeat it over and over again because it was going to create that repetition for no reason. But now, look, I'm just telling you, make sure you know this one. Outline the functions of the JSE, because I've seen it like 5 times and I was skipping it. I wasn't like putting it. So please take note. Make sure you know this one. Right. What does the JSE do? Okay, fine. What are its functions? Right, it gives opportunity for to financial institutions. Oh, sorry for that. It gives opportunities to financial institutions such as insurance companies to invest their funds in shares. It serves as a barometer. Okay, you know what a barometer is? It's actually geography. It's an instrument that is used to measure humidity, I think, if I'm not mistaken. Those who do geography, please don't kill me if I lied. But I think, yes, a barometer is an instrument that is used to measure humidity. So in this case, we are saying it serves as a barometer. That means it serves as a unit of measurement. Okay. So which or indicator, okay, of economic conditions in South Africa. When things are bad, the JSE will tell us. If you just want to know if the South African economy is doing well, you just look at the South African shares. You will see that something is wrong here. Okay, so it serves as a barometer or indicator of economic conditions in South Africa. It keeps investors informed on share prices by publishing the share prices daily. Actually, the whole time. Like you go on the JSE website, you will see exactly what's going on throughout the day, all the movements and so on. But in most cases, they'll show you prices that are 15 minutes delayed. And yes, at the end of the day, at least you get that information there. But there's a way of getting live prices as well. So if you really want, you can get that. Okay, acts as a link between investors and public companies. So if you are an investor and you like this other public company and you don't even know who's running it, of course you don't need to know who to contact if you want to buy shares. You just log on to your brokerage account, because obviously for you to get that link you need a brokerage account. So that means you need a stockbroker. I use Absa stockbrokers and Nedbank stockbrokers. So you can, I know some people use, what's this one? They use Standard Bank. I know people use FNB, but there's this one, what? JP Markets. Yeah, if I'm not mistaken. Okay, so it acts as that link. The next one, shares are valued and assessed by experts. So that's a good thing. So that's one of the things that the JSE does. And then small investors are invited to take part in the economy of the country through buying and selling of shares. So it doesn't matter how much money you have, as little as whatever it is that you have, you can participate also in the economy of South Africa. Venture capital market is made available on the open market. And venture capitalists, those people who buy shares of companies, but it's most common, in places where we have so many startups. In America, they have what they call the Silicon Valley, where many upcoming entrepreneurs would go. They have their tech company that's coming up and they need someone to fund the company, so they'll go to VCs, that's what they call them. And yes, so venture capitalists or venture capital market is made available on the open market. The next one, orderly market for securities. By securities here, we're referring to shares, we're referring to ETFs, everything. So orderly market for securities or serves as a disciplined market for securities. And then the next one, it encourages new investments. So those people who've never invested ever before, they can also, invest on the JSE. It mobilizes the funds of insurance companies and other institutions. And then it raises primary capital. Like if a company wants to start, it's a startup, it can go public, and then yes, that IPO, initial public offering. So the money can be raised to start whatever it is that the business is all about. It regulates the market for dealing with shares, and then plans, researches, and gives advice on investment possibilities. And then it ensures that the market operates in a transparent manner, and then provides protection for investors, encourages short-term investment. And the last one, It facilitates electronic trading, or strate. I don't know if I'm pronouncing it well, but it stands for share trading. What's the T? Totally electronic. Yes. So share, that's the S, and then TRA, that's trading, and then T, that's totally, and E, that's electronic. Okay, so it facilitates electronic trading of shares. That's simply what that strata means. All right, so we can buy shares on the platforms. So you open a brokerage account and then you buy shares. You don't necessarily have to go to the JSE, so everything can be done electronically. So the JSE, that's one of its functions. All right, let's go to the next question. Elaborate on the importance of investing in fixed deposits. Okay, why would you want to invest in a fixed deposit? Number one, interest is earned at a fixed rate, regardless of changes in economic conditions or climate. Look, one of the disadvantages of the vehicle that we just spoke about now, which is shares, one of the disadvantages is that if it's very, very risky. I lost a lot of money during this COVID time, and it's all because the market has been so volatile and mainly going down. And there are two companies that I bought that like closed, and I lost a lot of money with those two companies. So, look, economic conditions can change, and if you have fixed deposits, you will earn your interest regardless of that. So with shares, you stand to lose depending on what's going on. Right, the period of investment can be over a short, medium, and long term. So this means there is that flexibility. You choose what you prefer. It ensures financial discipline, as investors cannot withdraw their funds before the maturity date. So it gives you that discipline to wait. The next one, investors can choose the investment period that suits them. So you want to go, like I mentioned it on bullet number 2, that it is flexible. The next one, investors can earn better return on investment, ROI, that's what we normally call it, than on an ordinary savings account. Then principal amount plus interest earned is paid out on the maturity date. So you get your money, and that is guaranteed. It is a low risk, as investors are guaranteed of the final payment. I just mentioned this. Then the last one, the higher the principal amount, the larger the investment period, or the longer the investment period, the higher the interest rates offered by financial institutions. So what it means is, if you're putting 1 million compared to someone who's putting 5,000, insurance in financial institutions will give you a better interest rate. And the other side of things is, if someone is putting it for 2 months, they'll get a lower interest rate than someone who's putting it, say, for 5 years. Okay, it's as simple as that. Right, then tabulate the difference between compound and simple interest. First and foremost, when they say tabulate, they want you to do it in a tabular format. Okay, so it's simply 2 columns. We have the compound interest and we have simple interest on the other side. So it's an easy one. Let's start with compound interest. Interest earned on original amount invested, as well as interest earned on previous periods. So that means if you put 100 Rand and interest is 10%, if it's simple interest, that after 2 years, you are going to get 120. But the difference now with compound is, for the first year, you're going to get 110, and then they give you interest on that 110, which is fine for the first year, né? Then for the second year, then it's no, the principal is not 100, it's now 110, so you get slightly more than, so it compounds, right? So for the other one, simple interest, interest earned on the original amount and not on the interest accrued. So the interest that you accrue, you're not getting any interest on it. So obviously the best option amongst the two is compound interest. Then the principal amount grows with the addition of interest to it, and here the principal amount remains the same as I just mentioned, 100 compared to 110. And after the next year, we're now using 120 something, and then the next year, and so on and so on. So you will see that this one will grow exponentially, and then the simple interest is just going to grow by 10% on an annual basis. And in other words, that's 10 rand every month. The other one, the after 2 years, it will now be say 20 or something like that. Right, interest is calculated on the higher principal amount and again added to it. But on the other hand, with simple interest, the interest is calculated on the original amount, original or principal amount, and added at the end of the investment period. Then the last one, this one yields higher return, the other one it yields lower return. So this can present you with an easy response, because there is this question that they normally ask when they ask you which interest was used in the scenario above. The one that will have a big amount is the compound, and the one that has a small amount will be the simple interest. One of the reasons is the last bullet. The compound will yield more or higher return. The simple will yield lower return. Then the next one, explain how return on investment and risk may influence the decision to invest in shares. All right, I was telling you about my experience during COVID periods, and when you want to choose an investment vehicle, you look at risk, you look at the return on investment. So now we want you to be able to explain how can return on investment influence your decision as an investor. All right, so let's see the first one. This one, let's say a return on investment or payout or declaration of dividends depends on the decisions of the directors. So you don't have control on this one. The next one, dividends are paid in cash or in the form of additional or bonus shares. Like recently I received an email from what's this company? Growth Point. They are issuing dividends on the 1st of December. And so the email was for me to confirm if I prefer to get dividends in cash, or I want more. I want that the amount to be reinvested in buying Growth Point shares. So obviously, okay, I chose to be reinvested because that could be sort of compound, because those dividends I get them, then I use them to buy shares automatically. And yes, it's going to be like the scenario we had just now of it will compound. So yes, it's something that can influence your decision when it comes to investing in shares. The next one, investors have to pay tax on dividends earned. And then higher dividends paid out by some companies attract more potential investors. Then the last one, holders of ordinary shares may receive higher dividends when companies perform well. The other downside of this is, if you are an ordinary shareholder and the company doesn't do extremely well, then you get less dividends or even no dividends at all, even if that company is known to be paying dividends every year. The next one is risk. Shares have low to medium risk over a long investment period, because in most cases, they always say don't put all your eggs in one basket. If you diversify your portfolio, of course, I have 2 companies that closed and I lost a lot of money there, and it's actually a pity. That's where the risk is. But when we look overall, let's say if you were to diversify and buy, say, ETFs, then the risk becomes low. Right, shares with higher risks have a greater potential of higher returns, and in most cases this happens with what we call penny stocks. And it's it's those shares that are trading for, okay, in the American definition is less than $5, and so in South Africa less than $5, that will be any company with a share price of say 70 rand and below. But we have companies that are selling in cents, like 88 cents. There's a company that is selling for 1 cent. It goes up to 2 cents, it goes down to 1 cent. But if you look at that kind of a company, if you buy it at 1 cent and it goes to 2 cents, you have made 100% profit. But at the same time, if you buy it at 2%, at 2 cents, it goes down to 1 cent. Just that 1 cent movement, you've lost 50% of your investment. So the risk is bigger and the return is also bigger. And so there are so many people who trade penny stocks and they make a lot of money. They love that risk associated with it because anyway, it comes with big returns. There is a company that, okay, let me not keep talking about that. All right, ordinary shares have the highest risk as the investor may lose the full or part of the investment. Just like I said, I lost. It was Pumelel, the horse racing company. I was owning it when during lockdown. Then it closed. Then there was this property company from UK. I forgot the name, man. It's still, these companies are still on my portfolio, but I cannot sell. I cannot do anything. So that money is lost. Probably 60,000 lost. Right, preference shareholders risk is lower as they have preferential claim on the assets of the liquidated company, or may receive some compensation before ordinary shareholders. So we might not get nothing, but preference shareholders will get something. And then share prices are linked to factors that investors cannot control, e.g., economic conditions, like in this case it's COVID. We have no control over that. All right, then the last one, share prices are volatile. That means go up and down irregularly, which contributes to the uncertainty of the value of the investment in shares on the short term. All right, the next question. John inherited 350,000 from his mother. He wants to invest this amount in a safe and low risk investment, so I don't think you'd want to recommend shares there. Option with a guaranteed return where no charges, fees, or commission are payable. This is definitely not shares. So identify the type of investment that will suit John's requirements. Motivate your answer. Okay, the answer will be South Africa's retail savings bonds, or government retail savings bonds. The reason is because it is safe, and okay, you just reproduce what you saw there. Explain the advantages of the type of investment identified here. What are the advantages? All right. Easy to buy, as it is electronically available on the Republic of South Africa's retail savings bond website, or directly from the National Treasury, or from any branch of the post office or Pick n Pay. Number 2, the interest rate can be more than what banks offer. Then the longer the investment, the higher the rate of return. And then returns offered by retail bonds are good, as it can outperform the effect of inflation. So in other words, if inflation is at 6%, your investment will beat that. Investors can choose to reinvest their interest as at the same rate as the initial investment, and then interest is paid out or reinvested twice a year at a fixed rate. And then the last point, interest rate is fixed for the entire investment period, so it is not affected by the like when the Reserve Bank changes or adjusts the repo rate. All right, the next one, Mary and Tolo each invested 10,000 at the same bank, which offered both of them 10% interest per year. The bank applied different methods to calculate their respective interest amounts. Mary received 2,000 and Solo received 2,100 after 2 years. So the question then is, okay, of course, Solo, that will be compound, and then Mary, that will be simple. Identify, I mentioned it before, that you must always, the one that has the higher one will be compound, because she's getting interest on top of, you see. Right, so identify the methods used by the banks to calculate Mary and Solo's interest. Motivate your answers. All right, so the first one for Mary, like I said, it's simple interest. The reason, you can make some calculations there, the 10,000 times the, yeah, you see, that's easy. And then for Solo, that will be compound interest. The reason, if you make that calculation, you are going to get a bit more, 2,100. And besides this, so the only downside is your motivation. You must know how to calculate. So your motivation cannot be because it's higher. But I think you deserve 2 marks for saying, you deserve your mark. Oh, it's just 1 mark for your motivation to say, because it's higher than the other, because we saw it in that table when we're distinguishing the two, that the yield for compound is higher than the yield for simple. Unfortunately, you won't use that. Right, explain the difference between the methods. Okay, so you can tabulate the difference. We did this already. I repeated this because I was trying to avoid repeating something that we have already done. But in this case, it was that long question. So I wanted you to see that, yeah, it's a possibility. Right, then let's move on to the next one. Venter Pty Ltd. That means this one is a private company because it ends with Pty Ltd. So Venter Pty Ltd. Have been successfully operating as a private company, but now want to convert to a public company. In other words, they want to issue an IPO, or initial public offering, and then they get listed on the JSE, because in South Africa, that's the only stock market that we use. All right, so this will allow them to invite the public to buy shares. So name the institution that is responsible for listing companies. I've said it already. That will be the Joburg Securities Exchange. Yes, you'll be marked for saying stock exchange, but now they call it the Securities Exchange because it's not only stocks that people are exchanging. People are also exchanging what? Securities. No, people are also buying what do you call this? ETFs. They're buying a lot of things on the JSE. So to say stocks, it sounds like, oh, so you only buy shares on the JSE, of which is not the case. You can buy debentures, you can buy a lot of instruments, ETFs, ETNs, and so on, whatever it is that you want. All right, so outline any 3 functions. You see, they want 3, but yes, we did those many. I'm not going to go through this. I told you that this question has appeared many times, and I did not like repeat it many times, but here I did because, yes, like you can see, it was falling, under this one, which is a longer question. So I just wanted you to see what they could possibly ask. Right, name 5 factors that could be considered when making investment decisions. All right, number 1, you could look at return on investment. We talked about this. You have to look at risk. We also talked about risk. You have to look at the investment period or the term, as in, is it long term? Is it medium term? Is it short term? You should look at tax implications as well. In some cases, you want to avoid tax. And remember, tax avoidance is legal. What's illegal is tax evasion. And to avoid tax, okay, let me give you a good example, a simple example. If you buy shares and then you sell them at a profit, you are charged by SARS what we call capital gains tax. So if you buy shares and hold them, and then the share price is appreciating over time and you still hold them, that way you're avoiding tax. Now, it's not illegal not to sell your shares. You sell them when you want to sell. But what if the reason you don't want to sell is because you don't want to pay tax? You are simply avoiding tax. Is that illegal? No. You can even go to SARS and tell them that I'm not gonna sell those shares because I don't want to pay tax. They cannot say that's illegal. No, 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 no. You are not evading, you are avoiding. All right, so you look at tax implications. That one is a factor that you should consider, because in some cases you'll see, oh, this will charge more tax than this, and so on and so on. So that's a factor that one should consider. The next one is inflation rate. Yes, you should consider that. Should consider volatility. Some, forms of investments are highly volatile, and it's good for certain investors. For instance, someone who's a margin trader that person hates stable movement. That person wants volatility. That person wants, because for you to make money as a margin trader, there has to be that up and down going on. So you go long, you go short, and you do that because you're making money with the volatility. When it goes up, you buy. Then you close the trade, you sell. You close the trade when it goes down. So you're making money with the ups and downs. That's volatility. But now, if you're a margin trader and the thing is just moving slightly up, slightly down, so volatility can be a factor that you consider. Some want volatility, some don't want it. So it depends. So it's a factor. That's the point. Then liquidity. With liquidity, let me say, is it easy to turn your vehicle into cash? Yeah. How easy is it to turn your vehicle into cash? For instance, let's say you invest in taxis, or you invest in cars for Uber, just as an example. Ne? Of course, those are not securities. And then, yeah, you enjoying your business. You now have a fleet of cars. You have 10 of them. What if you decide, no, you don't want this industry anymore? How easy is it to turn those cars into cash? Turns out it's very, very easy. You can sell all your cars on on the same day, as long as you agree to whatever price people are offering. Because if you take it to say we buy cars, they'll buy it, but obviously they are going to offer you a very, very low price for your car. It's mostly unfair, but yeah, that's just me trying to explain liquidity, as in, can you turn it into cash, and how easy is it? The easiest thing I know that is highly liquid is shares, because the minute I go on the market and then I look at the prices, in most cases I pick market price. If I want to buy a stock, I want to buy it now. If I want to sell it, I want to sell it now. Okay, so I love shares because of that liquidity. It takes me less than 5 seconds to decide. Okay, no, the decision will take long. But if I've decided to sell Naspers, and if I own 100 Naspers shares, and each one costs 30,000, wow! If you have that, means you have 3 million. That 3 million, you get it within 3 seconds. Now, if you click on sell, 3 million is already cash. It has turned from shares to cash within 3 seconds. 3 is even more. Instantly, it's gone, and 3 million is cash. Then you decide whether you want to withdraw that 3 million or buy something else. But you cannot sell a house in 3 seconds. It's a long process. So property is not as liquid as shares. That's simply what we mean there. So liquidity is something that you want to consider. And then personal budget, yes, if you don't have much money, maybe you should go for ETFs. Maybe you should go for unit trusts. And so the more you have determines what it is that you're going to buy or invest in. So all these are factors that you should consider. The last one is additional costs, administration fees, brokerage fees also may apply. Like when you buy shares, for me, the cheapest is Nedbank amongst my brokers. They charge me roughly 70 Rand per trade. And then Absa charges me roughly 150, 160, 170 per trade. Okay, so I have reasons why I use both. And yes, let's leave it there. Outline 4 rights of preference shareholders. All right, these guys they enjoy a lot. One of their rights, they receive dividends regardless of how much profit was made. That's the nature of that type of share. Receive a fixed rate of return or dividend. They are paid first. They enjoy preferential rights to dividends. They have a preferred claim on company assets. That means if the company goes bankrupt, these guys are considered first. Then they receive interim and annual reports, and ordinary shareholders will probably have to go on the website and download, but these guys, they get them, so they are being preferred. They only have voting rights at the annual general meeting under particular circumstances for certain resolutions. And then cumulative shareholders must receive outstanding or accrued dividends from previous years. And then the last one, participating preference shareholders. Like I told you, there are many of these: cumulative, non-cumulative, participating, non-participating. So they are around 8, I think. Okay, so these ones, they have the rights to share in surplus profits. Right, let's go to the next one. Right, on this one, Khadija Printers Pty Ltd. So this one is a public company. It's a private company, sorry. Needed large amount of capital for expansion. Their management decided to convert the company into another type. Obviously, that will be public, so that they would be able to sell shares to the public on the JSE. Identify the form of ownership before they converted to another type. Okay, so they are private because it ends with Pty Ltd. And then explain the functions of the JSE where these guys can sell their shares. Like I did before, I'll just put a few, not all of them, and I'm not going to go through them because we did already. Right, elaborate on the meaning of compound interest. All right, interest is calculated in every period. That means if it's every month, every year, whatever, and then on original or principal amount plus the interest. And then interest is added to the original or principal amount, and interest is earned on interest for each defined period. Right, so as interest is added to the investment, the capital increases exponentially. Right, identify the type of preference share presented by each statement below. All right, this might sort of present me with maybe an opportunity of talking about these that I've been talking about, saying, yeah, there are many, and this one does this one does this. All right, let's try to establish a couple of differences here. Right, I'll start with cumulative preference shares. So with these ones, cumulative preference shares, dividends accumulate for the future, and if not paid in the current year. So like if dividends are not paid like this year, then those dividends accumulate next year or the year after. Whatever it is that is not paid whenever will accumulate. Then if you look at that, that's why they are called cumulative. Then we have those that do not accumulate, so we call these ones non-cumulative preference shares. And so for these ones, they receive dividends only and only if there are profits to be divided. Okay, so if there are no profits, then they don't. So the dividends in the fixed is a fixed percent of the profit. So what it means is, let's say if the company does not pay shares this year, with cumulative preference shares, they will be accumulating. Of course, we are not getting them now, but they'll be paid. But with the other one, non-cumulative, it means we'll only receive dividends if there is anything that has to be. So nothing is cumulative. So there's nothing like we are receiving dividends for 2 years ago, but with cumulative, they will. Then we have participating preference shareholders or shares. Right, these shareholders will share in a second dividend in a year when significant surplus or profits are realized. And then if it's non-participating, shareholders only receive a fixed dividend. Right, then we have what we call redeemable preference shares. The company will buy back their shares after a specific period. And then if it's non-redeemable, these shares are only bought back when the company closes down for reasons other than bankruptcy. And then the last two, we have convertible, right? These shares may be converted to ordinary shares after a fixed period. So that's why they're called convertible. And then the non-convertible preference shares, these ones, they may not be converted into ordinary shares. All right, so we have those 8, and I keep saying 8. Let me try to count them in my head. Like we said, we have cumulative, so that's 2 because it's cumulative and non-cumulative. Then we have participating and non-participative, that's 2. Now we have 4. Then we have redeemable and non-redeemable, and then we have convertible and non-convertible. So from that sort of summary that I gave on those 8, let's see which is which. Okay, so here we only have 2. So identify which one it is. Right, shareholders are entitled to shares in a surplus profit. All right, so you can see from my explaining there, this one will be participating preference shares. Then shareholders are compensated for past dividends. Okay, this one was the first one that I explained. That will be cumulative. Okay, right, then the opposite will be non-cumulative. So that's as easy as that. Right, name 3 other types. Okay, that's easy because I said 8 of them. Ordinary preference shares. Oh, these ones I didn't talk about them. Actually, maybe the ones that they are referring to as ordinary are the convertible, maybe. I don't know. Right, then, because I don't know ordinary preference shares, I don't know them. Right, then we have non-cumulative, we have redeemable, we have non-redeemable, then we have non-participating, because there we gave you participating, and then convertible and non-convertible. So it's not this one. I don't know which ones are referred to as ordinary preference shares. Okay, I'm going to make a research on those ones. All right, then the next one, discuss the following factors that should be considered when making an investment decision. Inflation, yes, you have to consider that. If that thing is beaten by inflation, then it's probably not worth it. So people are affected by a rate of inflation because their money or purchasing power decreases, yes. And as the SARB targets 3 to 6%, whatever vehicle that you decide to choose, you must just make sure that it beats inflation. That's the best thing you could do. Right, the next one. Inflation has a positive effect on some investments, such as property, shares, where the income will increase as inflation increases. So you must be careful which vehicle you use. The investment period can be short, medium, or long term, depending on, the period. Oh no, we didn't talk about it. Then short-term investments enable investors to access their money on a short period if needed. Then the longer investment period, the higher the return. Right, the next one is return on investment. We did this one, so I'm not going to go through it once again. Right, then we move on to the next extract or scenario. Retabile training and logistics have increased their number of clients because of the quality of the service offered by the business. The management of Retabile training and logistics have instructed the bank to manage their investment in a diverse portfolio managed by a specialist. Okay, this one sounds like unit trust. So identify the type of investment option that is applicable to the scenario above. This will be unit trust, but nowadays this answer can also be ETFs as well, because ETFs, they are also managed, and it's also a diverse portfolio. It's also managed by an expert. So I think we can also add that one. All right. Then the next one, discuss the advantages of the type of investment identified in the question above. All right, let's have a look. Right, the investor has a variety of to choose uh, from a wider range of shares and lower degree of risk. Then safe investment as it is managed according to the rules and regulations. So we're saying unit trusts are safe. And then the next one, a small amount can be invested per month. Yes, so it's good if you don't have much money. And then it's easy to invest in, and investors simply fill they simply fill in several forms to invest online. So that one is quite simple. Right, easy to cash in. That means when you want your money, it is easy. And then fluctuations in unit trust rates of return are often not so severe, so it's not too volatile because of the diversity in the fund. Then generally beats inflation on a medium to long term. And then it offers competitive returns in the form of capital growth and dividend distribution. Then the last one, fund managers are knowledgeable, they are experts, they are reliable and trustworthy, as they are required to be accredited to sell unit trusts. All right, the next one, outline two rights of ordinary shareholders. All right, us. We have the right to vote at the annual general meeting. We have the right to attend an annual general meeting to learn about the company's performance. Then you have the right also to receive interim and annual reports. And then you have the right to claim on company assets in the event of bankruptcy after all other creditors and preference shareholders have been paid. Right, next extract. Ronette wants to invest 30,000 in a fixed deposit for 2 years, and she approached two banks. Saints Bank offered her 12% simple interest per annum, and then Caprica Bank 12% compound interest per annum. So obviously I would choose Caprica Bank because it's compound, so I would make more money to my 30,000. So calculate the interest amount Ronette will receive after 2 years if she invests with. Okay, so you use the formula, just follow this. Should get 30,000 times 12% times 2 years. That is simple. That's principal times rate times the time. And then calculate the other two questions there on the next slide. Okay, calculate the interest amount Ronette will receive after 2 years if she invests with Caprica Bank. Okay, I normally prefer to use option 1, like that formula. It's simple, so you can follow that. It's quite simple, but if you want, you can use option 2. What matters is you arrive to the same answer. So they will mark you for option 1. It's the one that is straightforward, and it's not as complicated. So just to avoid confusion, see which one works for you, then use that one. Right, so the next one, recommend the best investment option. Obviously, we're going to go for compound. The reason is it's the one that's going to give us more money. Right, the next one, Nelly won 500,000 in a lottery draw and decided to invest the money in a fixed deposit we talked about fixed deposits earlier. The bank offered her an interest of 12% compounded annually over a period of 3 years. So define compound interest. It is interest is calculated every period on the original. We did this before. We defined compound already. Calculate the amount and then name another type. All right, here's the calculation. As usual, I'll go for option 1. You have your year 1, your year 2, and so on. But if you want, you can use the other formula and see which one is best. But I highly recommend option 1. Is the one that's not going to confuse you at all. Right, then the last part, name another type of interest that could be offered. Okay, that would be simple interests. All right, the next one, state 4 types of preference shares. Okay, we've done this one. So I'm just gonna, you know, go through them like this. I even defined all of them. Then outline the advantages of unit trusts as a form of investment. Okay, unit trusts are safe. They are managed by people who know what they're doing. They are experts who manage these. The investors have variety or a wide range of shares to choose from. Consequently, with a lower degree of risk. Then a safe investment, I mentioned this. A small amount can be, in some cases I see they say 300 rand a month. Over a long time, it's going to be something, right? It's easy to invest in. There are so many companies that are offering them, and so on and so on. Okay, so you have all these points on unit trusts, the advantages of them. So you can just have a look. Right, the next one, explain liquidity. Okay, I tried to explain it when I was explaining on buying shares and so on as a factor that may be considered when making an investment decision. Okay, a sum of money could be invested in a type of investment that can easily be converted into cash, just as I said. The term is used to describe the ease and speed. Look, I was talking about seconds to buy to sell shares. Just that shows how liquid shares are, with which investors can convert an investment into cash. All right, example. Okay, I gave you an example already. You can go through this one. Right, the next one, identify the type of business investment opportunity or opportunities that were used by prime plumbers in each statement below. All right, prime plumbers invested 50,000 for 6 months at 12% interest with a financial institution. Okay, that sounds like simple. Oh, it's a fixed deposit. Okay, sorry. Prime plumbers, I confused it for interest, type of interest, not seeing that it's talking about investment opportunity. All right, prime plumbers receive dividends. Okay, that will be shares. Right, so this brings us to the end of investment securities. All right, as usual, I would like to thank you for watching to this point, and please subscribe to the channel. So many people are watching my videos, but many of them are not subscribing. Please, please, please do subscribe, and yes, it's going to help.